Before we jump in, let me ask you a simple question. What if building wealth didn't require luck genius or endless research, but just one incredibly simple strategy? Most people believe investing is complicated, risky, and full of traps. But the truth is, there's a method so straightforward that even complete beginners can use it and still outperform most experts over time. Today, we're going to break it down in the clearest way possible. So sit back, relax, and let's uncover the simplest path to long-term wealth that almost anyone can follow. If you could invest in the entire stock market with a single click, would you do it? What if I told you this is actually possible? And it's one of the most successful investing strategies in history. Welcome to index funds, the simplest way to invest, even if you know absolutely nothing about stocks. Most people think investing means picking individual companies, analyzing charts, and somehow predicting which stock will be the next Amazon or the next Apple. But here's the truth. Almost nobody tells beginners. You don't need to pick stocks. You can buy the entire market instead. And that's exactly what index funds allow you to do. Today, I'll explain index funds in the simplest way possible, what they are, why they work so well, why even Warren Buffett recommends them, and how you can start with almost no knowledge at all. And by the end, you'll understand why index funds might be the easiest path to long-term wealth for normal people. Let's begin. So, what exactly is an index fund? Think of it as a giant basket. But instead of holding fruits or groceries, this basket holds stocks. Hundreds of them, sometimes thousands. An index fund doesn't try to beat the market. It doesn't try to guess which company will win or lose. Instead, it simply copies a market index like the S&P 500, the collection of the 500 biggest companies in America. If the S&P 500 is a list, then an index fund is a mirror of that list. Whatever companies are inside the index, the fund buys those same companies. If Apple is 6% of the index, the fund automatically holds 6% Apple. If Tesla is 2%, it holds 2%. If a company gets removed, the fund removes it too. It doesn't argue, it doesn't predict. It simply follows. This is why people call index funds passive investing. You're not trying to outsmart the market, you're letting the entire market work for you. But here's the fun part. Why is something so simple so incredibly powerful? Why do index funds outperform most professional investors? There are 3 big reasons, and every beginner needs to understand them. First, when you invest in an index fund, you're investing in the entire economy. Not one company, not 5, but hundreds all working for you at the same time. One company might fail, another might struggle. But meanwhile, dozens of others are growing, expanding, innovating, and becoming more valuable every year. When you invest in a single stock, your success depends on one company's fate. But when you invest in the whole market, your success depends on the long-term growth of the entire system. And historically, the market goes up. Not every day, not every month. But over decades, the market rises because human progress rises. We invent, we improve, we build, we grow. And the stock market reflects that. Second, index funds automatically diversify your money. Diversification simply means don't put all your eggs in one basket. But the beauty of index funds is that you don't have to manage dozens of stocks yourself. The fund does it for you instantly and automatically. Instead of buying one company, you buy the entire list. If one company collapses, it barely affects your investment. If one company explodes in value, you share in that growth. And because the index constantly updates, removing weak companies and adding new leaders, the fund stays healthy on its own. You don't have to babysit your investments. The index evolves for you. Third, index funds have extremely low fees. This might sound boring, but it's actually one of the most important advantages. Traditional funds hire teams of analysts, researchers, economists, and portfolio managers, all trying to beat the market. And guess who pays for all that you do? Through fees. Index funds don't need that. They simply follow a preset list. No guessing, no researching, no forecasting. This means the fees are tiny, often less than 0.1%. Over decades, that small difference compounds into thousands of dollars saved. Low fees. More of your investment stays invested. So now you know why index funds work. But how do they actually behave in the real world? Imagine the S&P 500 grows 10% in a year. If your index fund tracks the S&P 500, it will grow almost exactly 10% as well. If the market falls 5%, your fund falls around 5%. It's like being tied to the market with an invisible rope. Wherever the market goes, you follow. No guessing, no timing, just following the long-term trend upward. Because despite short-term chaos, the long-term story of the market is remarkably stable. Over long periods, it grows. Now, let's compare this to stock picking, the method most beginners think they need. Picking stocks is hard. Really hard. Even professionals with PhDs, research teams, and decades of experience fail more often than they succeed. They're not just trying to be good. They're trying to be better than everyone else, while competing against supercomputers, algorithmic trading firms, and the smartest analysts in the world. And yet, study after study shows most professionals can't beat the market consistently. But index funds, which simply mimic the market, often do. It's like trying to pick the one winning horse at the race, versus owning a tiny piece of all the horses. You might not win big, but you almost never lose big. And in the long run, slow and steady usually wins. So, what kind of returns can index funds actually deliver? Historically, the S&P 500 has returned around 7 to 10% per year after inflation. That might not sound flashy, until you realize the magic of compounding. If you invest $100 and it grows 10%, you now have $110. Next year, you earn 10% on $110, then 10% on $121, then 10% on $133. It's growth on top of growth on top of growth. Over decades, this becomes enormous. $100 invested for 30 years at 10% becomes nearly $2,000 without lifting a finger. Index funds aren't designed to make you rich fast. They're designed to make you wealthy slowly, steadily, and reliably. So if index funds are so simple and effective, how do you actually start investing in one? There are only 3 steps. Step 1, choose a platform. In the United States, popular platforms include Vanguard, Fidelity, Schwab, and many apps that offer ETFs. In other countries, there are similar options. The key is to choose a reputable broker with low fees. Step 2, choose your index. Most beginners start with the S&P 500 because it represents the biggest and most stable companies. But there are also total market funds, international funds, technology indices, and many more. If you want simple, start with one index tracking a broad market. Step 3, invest consistently. Monthly, quarterly. Whatever schedule works for you. Just make it automatic. You don't need to time the market. You don't need to wait for crashes or corrections. Just invest steadily, like adding drops of water into a bucket. Eventually, the bucket fills. And here's the twist: nearly everyone misses. Warren Buffett, the most famous investor of all time, recommends index funds for most people. Not stock picking, not complex strategies. Simple index funds. He even famously said that when he's gone, most of his family's money should go into index funds. Why? Because they work. Not because they're exciting. Not because they're glamorous. But because they quietly, reliably build wealth over time. You don't need genius. You don't need luck. You just need patience. So let's recap the entire story in one sentence. Index funds let you own the whole market with low risk, low fees, and high long-term reliability. You don't need to know how to pick stocks. You don't need to predict anything. You just need to follow the simplest, most time-tested strategy in investing. Buy the market. Hold it. Let time do the rest. If you're a beginner and you want a path that's simple, safe, and proven, index funds might be the closest thing we have to a cheat code for building long-term wealth. And now, you understand exactly how they work. If this video helped you finally understand index funds, imagine what you could learn next. Investing doesn't have to be intimidating, it just needs to be explained simply. So if you enjoy clear, calm explanations like this, feel free to subscribe and stick around. We explore the big ideas of money markets and human behavior, without the jargon and without the noise. Thanks for watching, and remember, you don't need to predict the future to build wealth. You just need patience and a plan. I'll see you in the next one.